nice to actually.
Great. Thanks so much, everyone, for joining us today. We'll go ahead and get our first session of the morning started here in the IDFC Pavilion. So, of course, I'll start with a big thanks to IDFC for hosting us today. So my name is Ian Cochran, and I am the head of the Secretariat of the Mainstreaming Climate in Financial Institutions Initiative, as well as a senior advisor at I4C, Institute for Climate Economics. And our initiative is very happy to partner today with the French Development Agency, AFD, to bring you today's event, where we'll be focusing on the topic of managing transition risks, specifically for development banks. As we've seen that this is definitely a topic that is getting more and more attention over the last few years. So I actually don't have a clicker, so if we could go to the next slide, please. Maybe before we just get the event started, I did want to say a couple of words on what our initiative is and what we do. So the Mainstreaming Climate in Financial Institutions Initiative brings together today over 50 public and private financial institutions, different forms of banks, whether development banks or commercial banks, to dialogue with each other on climate change and really exchange on how they're moving forward in integrating or mainstreaming climate change across all of their operations into their strategies and begin to roll out what is needed in order to address the different topics, such as, of course, climate-related risks, which we'll be looking at today, as well as the big topics of Paris alignment, carbon accounting, and overall integrating this into institutional policies and strategies. If some of you may not yet be a supporting institution of our initiative, you can definitely find out more on our website. The address is there. And of course, this is free for all institutions to join. So please don't hesitate to get in touch with us if you might be interested in doing so. Next slide, please. But that's enough about our initiative. What we're really here, of course, to talk about today is the topic of transition risks. And I'm really excited for the panel we have today. And I'll introduce each of our panelists when we get to the panel in a few minutes. But just to say, we have 3 panelists representing 3 institutions, the AFD, the EBRD, and KfW here in person. And then online, we're being joined by 3 representatives from 2 institutions, one from CDC Group UK, and then 2 from the European Investment Bank, EIB. And so this panel, this session will start with a short introduction from myself, just kind of laying out some of the highlights on what transition risks are and potentially why all financial, not why, potentially, but why all financial institutions need to be thinking about these. We'll then go into our panel discussion. We'll have a conversation both about how institutions are moving forward to assess these risks, but also discuss a little bit about how the results of those assessments are actually being integrated into management practices, particularly in the broader risk management frameworks of institutions. We'll then hopefully have some time for a question and answer with the room and potentially online, looking at my colleague Alice to see whether or not online questions might be possible, and she's nodding yes. And then we'll hear from our, not just our CSO representative, but from Bella Tonkanagi, who will be speaking from the Climate Policy Initiative, who will present some of her takeaways from our conversation today, but also identify potentially from the broader climate community how we think how we can accelerate and move forward on this topic together. So, next slide. Again, I just wanted to start today's event with a short introduction of what climate-related transition risks are. So again, next slide, please. I think all of us here today, and particularly at the COP, are well aware that the transition to a low-carbon economy is a complex process that will happen over a relatively long time frame, although of course I think the key message over the last 3 days of the COPs is that that transition needs to happen as quickly as possible. But there's several types of risk drivers and potential consequences associated with that transition. So first of all, we have a lot of the risks related to the technological drivers. How is technology upon which our economic systems and society is is built upon, how will that change, at what rate, and what might be some of the gradual shifts versus some of the big breakthroughs or rapid transformations that might occur. Secondly, we have a set of drivers around behavioral change, where we're expecting in evolutions in terms of lifestyles, market dynamics, demand, supply, and all of the ways that this low-carbon, climate-resilient future may be different in terms of how individuals, households, as well as companies go about their lives and businesses, and their lives and business. Finally, and perhaps most everyone thought I'd start with this driver, we have the policy driver, where in order to reach our low-carbon goals, we actually need to put into place quite a few policy frameworks or strengthen those policies that are already in place in order to reach these targets. So here I think everyone thinks of carbon pricing, different forms of regulation, but we know it might be broader than that. And often it's hard to say exactly what that policy framework will look like both over time as well as in individual regions and countries. So next slide, please. So as we think about these different drivers, we run into a number of questions that highlight the uncertainties that when any economic actor or financial institution begins to think about this future, need to start to take into account and analyze. So questions such as what types of transition drivers will play out and when? What kinds of economic restructuring does it imply? How will the economic agents behave? And in each sector, which economic agents are developing timely capacities to adapt? Because in the end, this isn't just about the risks, but it's about each individual's actor's ability to respond to those risks in a timely fashion, given their relative resources and ability to do so. So going to the next slide, obviously I've talked quite a bit about the challenges, so hopefully I'm not, scaring anyone off. But what is also important to note, and I think our panel will really highlight today, is that financial institutions are moving forward on this already. And we really can document, particularly over this past year of 2021, a number of steps in the right direction to allow us to better assess as well as manage these transition-related risks. So in 2021, we've observed a number of trends. Firstly, of course, we're seeing growing pressure on financial institutions from regulators. So not only is this a subject that you should voluntarily begin to act on, in some sense and very soon, most, if not all, financial institutions will be required to do so. Secondly, and thankfully, we're seeing an increase in the number of tools and databases that allow financial institutions to begin to access the data on climate performance, such as GHG emissions and other useful points of information needed to assess these different risks in practice. Although, of course, sometimes there's big questions of what's exactly in that data and are all these different sources saying the same things. And that, of course, touches on this point where we've also seen progress in terms of standardization. And here, of course, highlighting the work of the NGFS and the different reference scenarios that they have released that can help financial institutions to begin to think about this in a standardized, or at least more close, moving towards a more standardized way of addressing climate-related risks in practice. And then other trends, of course, are, and I think we'll be hearing from a number of FIs that will definitely be talking about this today, is how they're building on initial pilot assessments to improve their methodologies, but also taking the results and integrated the assessment of transition risks into how they're engaging with their clients and counterparties, which is really a key issue that in the end, the risk that's important is the risk accumulated and aggregated within a single client and counterparty, not necessarily at the level of each project and transaction. And then finally, and probably one of the topics the initiative will be moving forward on in the future, is that there seems to be a feedback loop between transition risk assessments and transition risks overall, as well as alignment assessments and understanding the overall alignment of counterparties or projects transactions in general. And in some sense, we can start to say, if more as kind of a starting point rather than a conclusion, that at times if an institution is fully Paris aligned or taking actions to be so, there's a higher probability that they'll be less exposed to climate-related transition risks. So to close my introduction, just going to the next slide, I think today, this is actually the old slides, but that's, there must be a mistake there. So I'll start first with just the transit. We changed them last night. Apologies for that. But before I talk about this piece of work, I just want to highlight real quick, all this means in our conversation today is, and particularly as we think about public development banks and their specific role and their specificities in terms of how they intervene in the economy, that counter-cyclical role they play, and how they're able to really support their clients through a transition process rather than just assessing their own exposure. We see that this assessment of transition-related risks need to happen at different levels, at their own exposure, a project's exposure, that aggregate client exposure, but also as they engage with countries and subnational actors to also think about that overall societal exposure to these risks and what steps they can take to actually support the management of the risks, not just in their portfolio, but linked to the broader development objectives that they have in mind. And that, of course, needs to be highlighted in the actual strategies put into place to manage these risks. So how is that management of the transition risk helping also achieve goals around the SDGs, limit, increased contribution to overall climate goals and what has been agreed to in Paris, as well as really think about how to manage these transition risks in a just manner. Because in the end, we need to ensure that there's a just transition. And then we just wanted to highlight this, this guidebook that just came out from the Inter-American Development Bank, who unfortunately wasn't able to join our panel today. But we really see, and I think it will also hear reflected from all of our panelists today, that this specific role of development banks and that counter-cyclical, supportive role that they have to make sure that this transition happens in a just fashion across their areas of or their countries and sectors of intervention is really important. And they're in a place that's different than other commercial actors that might be a bit more concerned with, again, managing their own exposure and that downside risk rather than really thinking about how can we help our counterparties and clients through this process. So hopefully that has, going to our next slide, provided some insights to help kind of frame our conversation today with our panelists. And now, of course, I'll go ahead and introduce who we're going to be hearing from. So starting with those who are with us in person and starting down at the other end, we have Thomas Nicolas de Lalande-Ballery, who is the Climate Risk Deputy Head at the French Development Agency. We then have Effie Ritter, Head of Climate Risk and TCFD Delivery at the European Bank for Reconstruction and Development. And then Peter Hilligis, Climate Chief Officer of KfW Development Bank. And as I said, we then have 3 panelists from 2 institutions online, starting with Nicola Mastetia, excuse me if I mispronounced your last name, Climate Change Manager at CDC Group, UK, and then Maximilian Abt and Stephen Wagner, who are Climate Risk Officers at the European Investment Bank. So great, thanks. For those in the room, you can now see these, their faces online. And our panel, if we just now go to the next slide, will be structured in 2 parts. We're first going to have a first set of conversations about the assessment and some of the reason why these institutions are moving forward on climate-related transition risks and how they're actually assessing this again at the different levels I mentioned. We'll then have a second round where we'll be looking more again at the use of that information. How can this actually inform different assessments, whether at a project or client level internally, but more broadly within the frameworks of risk management in general within financial institutions, as well as, again, these links or synergies with broader Paris alignment and climate risk topics. But to start, we'll jump back to that first round of questions. And here I would like to start with Peter, if that's all right, to say a few words again about why KfW Development Bank is looking at this transition issue so closely in the transition risks, and of course, how you are already planning to conduct these types of assessments. So Peter.
Thank you, Ian. So it's good to be here and to discuss this topic. And let me start off with one remark or two remarks. One is that KfW is probably a little different from AFD and EBRD and EIB because we are having a couple of different mandates as a group. So KfW is a banking group with two subsidiaries, one for commercial export finance, one for private sector finance. And then we have our domestic business unit in KfW Group, which is actually 60% of what KfW is doing. And then we have the development bank, which I represent. So we have a share of 40% international finance, 60% domestic finance. That, I think, should indicate already that the issue at hand is quite a complex issue for us because each and every business unit is affected in a different way. Second remark, in 2017, end of 2017, KfW embarked on a transformation process. So our CEO decided that KfW really has to change business and that we have to become better in sustainable finance. And so he started something which we call the Roadmap Sustainable Finance. And this, I have to say, honestly, was a big change for the bank, coming from the top. Mm-hmm. And in a way, I mean, it also reminds me of your mainstreaming climate initiative because there we are a supporter of the initiative, and so we benefited a lot from the discussions we've been able to have within the initiative. And our CEO decided, yes, we have to go down that route. And so we put together a puzzle or a mosaic of different activities, and one of them being becoming a supporter of TCFD. Mm-hmm. So our risk people in the group decided, yes, we have to take this on board. We have to look at TCFD. It is something which will be relevant for our business in the KfW group. And so they started looking at risk assessments. And so initially we had a process of assessing physical and transitional risk, sector-wise. So they created a heat map and they said, okay, we have to look at our business areas and see which are the ones affected by physical and transitional risk. And the result of that process, which was actually also supported by the NGFS guidelines and work that they had provided, they came up and said, okay, transition risk is more relevant for us in the risk department. So let's focus on transition risk and continue working on the sectors which we had identified at that point as the most relevant ones. So it was kind of a funnel that we used in order to come from this big climate risk topic down to more manageable, smaller parts. And so they did this with some external assistance and external data. They went through this process and actually delivered a first TCFD report in 2020, of course, on a voluntary basis. And this, I would say, is the mid-term result of that work that we've been doing. So the driver was internal, our CEO actually, and the recognition that transition risk is relevant for the bank. And it went, by coincidence, in parallel with the learning process on the regulatory side. So our German regulator for the banking system, they also started looking at these things. And so they also had the same challenge as we did, that they needed to understand and learn how to do this. And so in a way, this went in parallel, and I think it's quite a fruitful process. And there was a lot of exchange happening between the German banking system, including KfW, and the German regulator. So this is actually where we are, and our Roadmap Sustainable Finance has now become a project. We call it Transform. So it's now in implementation, and we have, next to the risk component, we have issued 6 sector guidelines for highly emissive sectors, where we actually try to define what is the transition path for us financing these sectors. And there's a lot of interrelation. So if you have highly emissive sectors, of course, there are also a lot of transition risks. So this kind of interfaces. Then we have established a greenhouse gas monitoring system in order to actually understand whether our portfolio is improving in terms of the emissions or it's not, so that we can at some point review our system and start steering it again. And then there are 2-3 other components which I won't mention now. So, but this is where we are. So I would say on transition risk assessment, we are somewhere midway.
Okay. Great. No, thank you for giving those insights on how it moves from that combination of internal plus the regulator and really those steps forward in building that in-house capacity to do so. I would like now to turn to Maximilian and Steve, who are joining us online from EIB, to perhaps say a few words about the motivation behind addressing these risks, as well as what the European Investment Bank is currently or planning to do and to apply.
Hello, I have to ask you if you can hear me because I had some issues at the beginning. Yes, great. I always seem to have issues with Zoom. So good. Thank you. So good morning, everybody.
Perfect.
Good. So I'm afraid that I only managed to follow the last 2-3 minutes, so I couldn't follow the other answers. But Max told me that we are on the first question, and you reiterated the question. So I will answer it. So our concern in relation to transition risk has been quite a process, and was also a long process. We started, if I may say so, from the other side, from the front office side. So we are risk management. We have to admit that it started on the front office side. So already more than 10 years ago, we started financing a number of renewable energy operations in Europe. I mean, we had also, I think, one of the first also offshore wind farms that we financed. So on the front office side, our project directorates was always already conscious about transition risk and about the impact, the positive impact that projects can have on the environment and more specifically on the climate. Afterwards, this became over the years more and more specific. And several years ago, it was in 2017, 2018, the bank decided to be also more and more, even more active on the climate side. But this was always on the front of this side. And then afterwards, at that time, our director thought that, okay, we also need to think on the risk side. The first obvious risk that we're thinking about was the physical risk, because we were also all aware about the speech that McKenna did of Lloyd's, but then in front of Lloyd's. But then when we digged into the subject, we became more and more conscious that transition risk was actually also a very important one. And in the short term, this was next 5-10 years, at least for our portfolio, maybe even more important than physical risk, which becomes more important probably in the longer term, after 15-20 years. So we became more aware of the transition risk. And as an action, we decided, and I think that's also more the second question, we decided to set up a tool which allows us to score the transition risk and the physical risk separately. So I would say that means it was really a step-by-step process. It started with the front office, with EIB wanting to finance more and more climate-friendly operations. Then it came to risk management, and risk management, we became conscious that climate risk is important. We started also a little bit be more worried about the physical risk, and then afterwards we actually, by digging more and more to the subject, we noticed that transition risk in the shorter term, shorter to medium term, was also very important, if not more important, at the beginning.
Great, thank you so much. And I think that that connection back to that starting point for many financial institutions of looking at the physical risk before moving into the transition risk space is probably speaks to many of those in the room and joining us online. And I know it definitely speaks to Thomas from the AFD, because I think there potentially was a similar journey at the AFD. So maybe Thomas, I'll turn to you now and see how AFD began to move forward on this, and of course where you are today.
Yeah, no, absolutely. It fully resonates with us because that's how we started. We started looking at climate risks in the risk department in 2018, and as my colleague from KfW was saying as well, we soon it became quite clear that we needed to break that problem of climate risk into smaller breaks because of resources, but also because we needed to tackle what seemed to be the most important issues for us. And the first one that came out was really physical risks. So we started looking at it in 2018. We're talking about the drivers. I think for us, obviously there is the strategic driver, which is that looking at climate issues in general is really part of our DNA. It's part of our strategy. We've wanted to be 100% Paris aligned for several years now. That's really one of our big strategic statements. We're 50% climate. So looking at climate risk was really part of our DNA from the beginning. But one of the key drivers, even more than that, was actually the role of the French regulator, and they really. There were a few laws that were passed in France really encouraging financial institutions to look at climate risks, and that was a really, really big driver for us. So 2018 we started with physical risks, with the idea that actually probably that was the main risk for us, given our portfolio, given where we are active, and I still believe it's actually quite true. And so we worked on that for over 2 years, created tools on physical risks, and then after 2 years of work, we were, okay, now we need to look at transition risks. And that's when the stress test exercise organized by the French regulator kicked in 2020. And to be entirely honest, that was a bit of a kick in the backside for us. And we needed to really get our ducks in a row on that topic, and we barely started thinking about it, and that boosted all our efforts massively. So we spent about 6 months just working on that stress test, really thinking in terms of, really in practical terms, what transition risk meant for our portfolio, looking at the different scenarios that were offered to us by the regulator, NGFS scenarios, and we went on that learning curve extremely quickly. 2020 we answered the regulatory exercise, and then the next step was, okay, we've got a lot of data, we've worked a lot on that topic, what do we do with that? And well, we're going to create our tool to actually look at transition risk at each client's level, and that's what we did in 2021. We've developed a new tool, a matrix that will mix, in fact, a sector approach with a country approach, and give for each one of our clients a first initial score. And then that initial score will then trigger due diligence. So we've worked with the operations, with a lot of all the departments internally, actually the whole bank, designing due diligence questionnaires that can be easily used by all our teams on the ground. And that means the local agencies, that means operations at the headquarters, and that means the risk departments. So we've designed those tools, and they're just about to be launched, and they will be launched for all our new project, all our new clients in 2022. Okay. So that's where we are now. So yeah, the role of regulators is absolutely key for us. Was definitely the key driver.
And perhaps here to note, AFD, which may be different than a lot of development banks or development finance institutions, is subject to varying levels to actual financial regulation, which is not always the case, of course, for development banks, which sometimes sit slightly apart from the main broader financial sector regulation. But nevertheless, as we've heard from KfW and others, there's still those outward trends that do influence the internal politics. Now, Effie, I do want to hear from you about, of course, what the EBRD has been doing in the rationale behind this space. Is definitely EBRD has been very involved in the TCFD process, one of the first development banks to be a full, I don't know if the term is member, but supporter of the TCFD. I can't remember what the term is right now.
Yeah.
So I'm guessing there's a lot of different trends that kind of intersected to help EBRD kind of move forward in this space as well.
Yes, absolutely. I think that EBRD was actually the first MDB bank that signed up to be a TCFD supporter.
Yes, TCFD supporter. That's the term I was looking for.
Yes, so we were actually the first ones to do that. And, similar to what Thomas was saying, actually, we're all development banks. So I think there's a lot of similarities, perhaps, in what we do. And he took some words out of my mouth as well. So environment and climate risk and climate in general has actually been at EBRD's DNA pretty much from the establishment of the bank. And that's something that is a founding principle for EBRD as well. And then over 15 years ago, there was actually a department that was established on the front office, similar to what Steve was saying, that was actually looking at how do we actually look at climate, how do we assess climate, how do we actually consider the climate risks that are coming up, both from a climate risk perspective, but also, given that it started from the front office, from an opportunities perspective.
Mm-hmm.
And one of the drivers that leads EBRD, on top of it being actually the mandate that the bank itself has and something that is coming deep within the DNA, is also that, well, we're not regulated similar to some of the other banks that are here. It's our clients. So how do we actually support our clients? How do we help our clients? How do we actually lead the way and show the way to our clients to actually do this? And one of the most important way of doing it is being able to do it ourselves. And that's why we started. And in 2018, it was the first time that we've issued a TCFD report, pretty high level at that stage. And the process then really started to kick up speed in 2019, end of 2019, when it was actually moved to the risk department, and the understanding that climate risks are actually something that needs to be looked at from a regulatory perspective. If the intention overall is to bring it into the audited statements, into financial statements, and understand the financial impact, it is the risk department that needs to look at it. And then very, very closely working with close coordination with our front line that is focusing on climate action, we're working across the bank to do that. Now, again, I'm the third person to speak, so I'm going to repeat some things that have already been said, but very similar to what Steve has said, Thomas said, and also Peter, then we've actually developed a methodology that looks at both transition risk and physical risks. I wouldn't say that for us we've decided which one is more important. I think they both are, and we're actually finding that as we're screening, we're coming across different elements that have different impacts. Mm-hmm. However, the transition risk is actually more advanced in some ways because, largely because it's clear actually what some of the scenarios that the NGFS, which is becoming more and more of the body that provides the guidance on, is advising on what are the scenarios to do, what are the sensitivities to take, and then taking that and then being able to apply that to our counterparties that we're assessing them. We're doing it in similar fashion to what was described. So we have a methodology that's looking at sectors, that's looking at counterparts, that's looking at the country that they're in. We're also taking into account the tenor because we think that tenor is a factor that's going to that's going to play a role. And as we're looking at running this across both our new deals that are coming up, but also our portfolio, mm-hmm. actually understanding what's the impact and how long those deals are actually going to be on our book is actually very important. It's a process. It's not something that's going to happen overnight. And we've actually got a very clear, defined, but over time laid out plan of how we're going to start doing that. So today, for example, every new deal that's coming in, we're screening that deal for transition risk. We're actually applying a score to that transition risk. And then if the score is considered to be in a high sector or high score, then that's being taken back and being actually looked at in much more granular terms to understand mm-hmm. actually what does that mean for us? What does that mean for the bank? What does that mean when we apply actually a sensitivity of a carbon price on it? And what does that mean of the actual ability of repayment for us? So that's in a small nutshell some of the elements that we're bringing across on the institution level.
No, great. Thank you so much. And I think highlighting that importance, of course, of thinking of that client focus, both the risk and opportunities, and then, of course, the last point as well, thinking about the capacity of the client to respond to those risks are definitely key issues to hear. And hopefully we'll hear a little bit more from the whole panel on similar points a little bit later. Just for the first round and more around the first question, we might still dive a little bit more into the second question. I'd like to now turn to Nicola from CDC Group to hear a little bit about your experience, because I'm sure as well that client-focused and support issue is definitely, I'm guessing, present and how CDC Group has moved forward on this.
Great. Thanks a lot, Ian, and I hope you can hear me as well. And good morning,
Yes, we can hear
everybody. Great. I hope you can see me as well, because I'm on 2 devices, but hopefully that gets sorted. So our, I guess, journey on TCFD and transition risk, in particular, I guess, started in 2019 when we decided to become a TCFD supporter as well. So that actually preceded the development of our climate strategy that we published in 2020, and was a kind of key influencing framework for our broader climate strategy, and also the link with the Paris alignment approach, Ian, that you touched on, that we will come on to as well. So we decided to commit to TCFD in 2019 because we really saw it as the best practice framework for financial institutions to integrate climate risk. And also clearly there has been a lot of work done by the Bank of England, ahead of TCFD being established, on physical and transition risk and how it translates into financial risks as well. So from a broader, I guess, UK perspective, I guess it was very much, integrated in terms of how we considered climate risks. The other thing I wanted to mention is, again, this point I think that was made around leadership and governance as well, which obviously is a key starting point for TCFD. So we had a lot of support from our chief, investment officer, our chief risk officer, our chief impact officer, who really set out their different roles and responsibilities around climate risk. So we really had that sort of top-down leadership to help us to start implement some of the measures. The other point that I just wanted to mention is, I think there has been this really shift in thinking around climate in financial institutions and DFIs in the last couple of years, particularly since the Paris Agreement, that basically to stay within the 1.5 degree budget, there will be substantial economic transformation needed across all sectors. And I think that links to transition risk in the way is that, if you just assume business as usual, basically in these sectors, that's probably not a prudent business strategy. So I think there was a sort of increased recognition internally on really that sort of transformation that will be required to deliver the goals of the Paris Agreement, and how that then can potentially translate into transition risks. And these transition risks can then both influence our financial return, but also our development impact mandate. We have a dual mandate, like all the institutions, I guess, on this panel. And for us, it became pretty clear, that transition risk can both be a financial risk, in terms of the long-term viability of the businesses we're investing in, but also in terms of the development impact that we wanted to achieve. So it really was intrinsically linked to that sort of dual mandate consideration. But I think, Ian, to finish up on this question, I think the other point that is really important for us, we're DFI, we invest only in emerging markets. For us, it's really important that transition risks need to be considered according to the different, trajectories of the markets that we invest in. And therefore, to your point that you made earlier, that sort of engagement, client engagement, portfolio company engagement, to really help them with the transition rather than just identify it for themselves, is an actual core part in terms of how we approach some of this in terms of our processes. I think that we come on to as well.
Great, thank you so much, Nicola, and I again for seeing those trends, for sometimes how this is an issue that even predates broader climate strategies for some institutions, as it's so much closer to both mandates, whether the financial or the development. Before we move to the round 2 of questions, and I think we have time to do this, I just wanted to see if any of our panelists might want to say a couple of words on, again, this how, the tools and the processes, because I think now we kind of have a high-level vision of what you're doing. And of course, we don't have time to workshop each tool. We could spend days doing that. But I think it might be interesting for the audience, and I know for myself, to maybe hear a few words about how are you going about combining a mixture of probably both qualitative and quantitative data to do this? So really that kind of that balance and the use of the two, not just to, again, assess the exposure, but also maybe to think a little bit about the capacity for the client to adapt or to respond to the risks? What is their resiliency? So again, we probably can't delve into that in much detail, but it'd be interesting to hear from different panelists. So now looking at those are online, I don't know if anyone wants to specifically start. Okay.
Yeah, there was something that crossed my mind when all of you were talking. It is this transition risk and TCFD and all these activities are handled by our risk department. So I'm not part of the risk department. So I'm the chief climate officer, and I'm looking at impact. And I obviously immediately find that there is a mismatch between the risk perspective and the impact perspective. Because our people in the risk department, they look at banking risk, they look at exposure, they look at the tenor, as you were mentioning, and then they say, okay, we have an average tenor of 8 years, and so this is what we are considering in our risk assessment. And I'm from the impact side, and we are looking at 20 years. So you have a mismatch there, which we haven't been able to handle yet. Probably we will continue having both systems in place, because then you have two opinions, and then you can strike a deal, and you can say, okay, this is worth it because impact is high, and we take the risk. But this is one important factor for us in our work. And the other one is that physical risk is deeply embedded in our daily project work anyway. So we have a climate mainstreaming process, we call it. So each project runs through a screening process for physical climate risk. So be it country, region, sector, or concrete activity, or all of them. So this is something which we do on the impact side, and then the transition part is done by the risk department.
Okay, no, that's great to hear that interaction, which I think everyone again also is dealing with between departments that might be speaking slightly different languages at time and different time horizons and frameworks. Thomas or Effie, I don't know if either of you would like to
Sure, I'm happy to sort of add on. So that's quite interesting actually to hear what Peter was saying, because I am from the risk department, and this is actually what we.
I think we both are on that end of the table.
Yes, we both are actually. So this is actually what we look at, and. For us, actually, when we look at this, and that's very true, actually, we would have this actually debate in a higher level once actually the risk department does actually assesses what is the risk, what's the climate risk ultimately to the bank, how is it impacting us internally, and then we obviously look what is the project actually potentially leading to. But something that comes into play as well is that one thing is actually assessing that risk based on the sector, based on the client, but we would also, and based on the sensitivities that we would apply, but we would also then look and seeing what is the transition plan that that company has in place. So that actually comes and becomes very credible actually in terms of the ability to understand that risk. And I think when you're actually talking about some of the implementations and what we're looking at building a system that allows us to actually do two things. On the one hand, be able to scale it up pretty quickly so we can come up and we can actually score something fairly reasonably and quickly. And then at the same time, then take the ones that we perceive to be at a high sector, a high risk, take that deeper dive in. And I think that in listening to some of the colleagues here, a lot of people are doing a similar approach in doing that. And I think that is so important, because one of the points and one of the elements that's being asked is actually, how comparable is it? How can we compare the risk that you, EBRD, have on your books versus KfW versus the AFD and other institutions? And a metric that comes to my mind is, for example, EBITDA, that people look at in the risk world, for example. And EBITDA is by all means, not a perfect measure. It's actually a pretty bad measure. But the one thing that's actually fantastic at is that it's comparable, it's easy, it's simple, and it's standardized. And that's what we're trying to actually achieve by actually creating these climate risk scores, which we then actually are able to publish. So we've published our TCFD report. Well, I guess I would probably say it's our second standalone one, and actually quite a detailed one. And we've published that a few weeks ago, and we actually detail our portfolio, and in terms of which sectors are high risk, which sectors are low risk, and we actually do a score for the whole portfolio that we actually do. And that is actually done on, and you're asking actually how is it done in practical terms, that's actually done very labor intensive, so that's deal by deal. There is a questionnaire of information that's coming in. There is a person assigned to it. There is a score that's being derived, and if it's a score that is either in a high risk sector or high risk score, then it's what we call the second stage assessment, which brings onto the table the various people, from the banker that is responsible for it, from the credit manager that is looking at it, from the climate risk person who will be supporting it, and from our climate action team who also has the expertise and the engineering and the knowledge on transition risk. We have something similar on physical risk, and we've got our environmental team involved in that. So that's the process. It's a pretty labor intensive, pretty complex. What we're trying to do, similar to what Thomas was saying, is just to make sure that we're also trying to focus the attention on the sectors that matter. Ultimately, one of the process that we've brought on board is actually to make sure that this is covering all the projects, all the deals. But the intensive effort, the intensive interaction is actually going to be on the sectors that have that big exposure, that big carbon exposure, the high reliance on energy, the big emitters, and those would be the ones that we would focus on.
Okay, great. Thanks, Effie. Thomas.
Yeah. Well, so I mean, Effie said, most of the things that we're thinking about at the moment and we're doing as well, which is we're looking at the quantitative data really for an initial score to have an idea of the level of vulnerability of a client which is active in a sector and in a country, and that can be automated quite easily, and then that's really the quantitative data. Once you've identified a client potentially vulnerable, then that's where the qualitative side of things kicks in, and there's no, there are no. You have to speak to your client to get those data, and so we've tried to design questionnaires that are fairly easy to use, fairly easy to understand, and that will bring us the data we need and the information we need to know. Well, if the client is on a transition path or not, if the client is actually really vulnerable or not, and that's really qualitative data that we need to be able to process. And that can be automated. At least we don't know how to automate that.
Yeah.
So, but yeah, I think that's very interesting what you were saying, Effie. The necessity to be able to compare data, to compare assessment among banks as well, like between banks, making sure that we're following the same kind of processes. It sounds like we are, all going in the same direction. But cooperation between us is absolutely key to nail this topic, and that's. It's a complex one.
And that's exactly why we're trying to have these type of conversations here. And now I want to turn to our online speakers again. Wasn't trying to exclude those, but just exclude them, but starting with those in the room. So I don't know if colleagues from EIB or from CDC Group might want to add a few words on that kind of more practical how to do it challenge, as well as, whether it's about the data or even about working across different parts of the institution itself.
I'll let CDC start if they wish also.
Okay, sure. Thank you, Steve, and thanks, Ian. So I think for us on the practical side, there are probably, I would say, 4 areas, and a lot of what was said, I think, resonates with us as well. So I think one is around the sort of broader, institutional governance you establish around your climate risk framework. And the other is around, portfolio level climate risk management, transaction level integration, as well as client engagement. And we've started work basically on all of those areas. And I think the point that, Peter made around, I guess, the different, views from the impact, versus the risk side is a really interesting one. And what we try to do is, on the governance side, we established like a senior level climate risk basically group that oversees all of our work on TCFD implementation, including transition risks at portfolio and transaction level. And that's kind of, spearheaded by our chief impact and chief risk officer. That's not to say that sometimes, there are different perspectives, but at least it provides, the forum to try to bring it together. On the portfolio side and more on the quantitative side, we footprinted our finance emissions across our entire portfolio for the first time last year. And clearly that gave us some sort of indication of, where are really the highest emitters on the direct side in the portfolio, but also on the intermediated side through our funds and financial institutions portfolio, which is, really useful then to think about, okay, what could be our engagement, strategy with those sorts of investees to, again, help them in the transition as well. And we will conduct further work around how do we actually, embed scenario analysis to assess also our own risk as well. And then on the transaction level side, again, transition risk now has to be assessed across all investments, but similar to Effie, I guess we focus obviously on those sectors where the risks are, potentially more material. Here I would say our process at the moment is still relatively qualitative. And the way we're doing it is on a transaction level for new investments. We hope that we reduce quite a lot of, transition risk because we have a new fossil fuel policy in place, that is aligned with the UK government's policy that was released towards the end of last year to end, fossil fuel financing, overseas, except for very rare and limited, basically, circumstances. So from that perspective, we hope that that sort of, clear exclusion list limits our transition risk exposure for new investments quite substantially. That said, there's still, high emitting, investments outside of the fossil fuel, basically sectors, or even within the fossil fuel sectors that we have to consider. And particularly for the gas power sector, which is still a sector that we can consider in exceptional circumstances, we developed our gas guidance tool, which helps us to assess Paris alignment and transition risk, and sets out a range of indicators when we would consider a gas power investment aligned with a country's pathway to net zero emissions as well, and also where we also have to consider transition risk questions as well. And then for other investments outside these more, traditional fossil fuel sectors, for example, in high carbon, manufacturing or agriculture, investments in these areas basically have to answer a set of, transition risk questions and also on their transition plans as well. And then I guess on the client engagement side, for us, that's particularly relevant for our intermediated portfolio. So we invest, in funds, we invest in financial institutions. And what we've done here in our kind of interim climate risk process is really set out a process on what funds, on what financial institutions should we really focus in terms of our climate risk engagement, in terms of, their strategy, their size, their capacity, our influence as well in them. And we develop guidance for them, a TCFD ready guidance that we help to embed with those sorts of institutions where we kind of consider them to be highest risk. So yeah, as you can see, coming from the top down in terms of, governance and broader portfolio level management, but then also the transaction level and client engagement, where we're really trying to think through the transition risk angles, but there's certainly more to do on our end as well.
Great, thank you, Nicola. And I think definitely starting to touch on some of those topics we'll see coming back now in the second part of the discussion, particularly on what you're doing with these results and how that's fitting into the broader engagement or decisions made around specific clients or projects. I don't know if colleagues from EIB might want to say a word or two on that data question. If not, happy to also, as I'm probably starting to run short of time, move into round 2 of questions as well.
Yes, maybe we can. Maybe I can answer both questions at the same time. I mean, we can talk about the data and also what we do with it.
Perfect. That would be great if you just want to dive directly into that round 2 of, really, again, beyond just assessing what do we do with this data, this great analysis, and then how do you actually, again, try to link it up to all those different types of impacts we've been talking about, whether, ensuring some, financial performance, but also the development and environmental specific, and of course, the climate outcomes.
So it's okay. I will try to be short because it's I'm trying to answer 2 questions at once, and I'm conscious of time. So very quickly of what we have in place now, we do have, as all of you, a climate risk tool in place. We started rolling it out last year. It was version 1. Now we have a version 2, which is in place. As I said before, the climate risk tool allows us to assess our counterparties' vulnerability without both transition risk and physical risk. So we have a dedicated score for both because we didn't want to merge both of them. So basically, this tool, as for all of you, is a combination of quantitative data and qualitative data that we have. So we are looking into the revenues that they have per geography and per industry. And depending on the geography and industry, we get a certain preliminary transition score, and then afterwards some adjustments are made, and also which also take, for example, into account mitigation factors, which are of course much more qualitative. What do we do? I mean, also maybe something specific, and maybe also because it's important for the last question when it comes to Paris alignment. Our tool allows us to assess the vulnerability of our borrowers, so our counterparties, our borrowers, not of the projects. From a risk perspective, it was important because if we know that the counterparty is late in its transition, and if this has a financial impact going forward, so whatever the underlying however green the underlying project is, however climate friendly the underlying project is, we still facing a financial risk of our counterparty, of our borrowers. So it was important that from a risk management perspective, at least, we have a borrower approach as opposed to a project approach. Which is not to be disregarded. That being said, but it was important to do our mapping. It was important to have this approach. So now that was very brief. Now to the next question: what do we do with this data that we have? Many things. Some things we've already done, and some things that we intend to do. So what we already done is that we put together a heat map. When I say heat map, well, we actually did several heat maps. These heat maps are not done. I mean, these are not heat maps that you normally see, where you see the physical risk as the physical sensitivity of each country. But these heat maps are more tailored heat maps, which allow us to see by which credit segment and which industries are the most sensitive to transition risk. We have them by credit segment, by industry, by country. And we have, of course, as to make it a little bit more colorful, we have different colors, so green being not very risky and red being very risky. This allows us indeed to see we need to focus, because this can be used as a decision tool. So our management committee or our board can see, which areas are the most sensitive to transition risk, and maybe also then going forward take the decision that we should not going forward lend to these counterparties. I say maybe, yeah. So, but it will allow us to. It will be not only will this be an informative tool, but will also be a decision tool. So that's. That was also the primary aim of our current risk group, to actually to have a good overview about our counterparties' vulnerability to transition and physical risk. Then we'll also use this data to do our sensitivity analysis, because, and Effie was also mentioning before, so this will allow us to identify our most risky counterparties, and based on this, we can perform sensitivity analysis. The other thing is we also, and that's for next year, we'll have to integrate this also into our risk appetite framework. Risk appetite framework will include some KPIs, and some of the KPIs which are climate risk related. One will be probably the green asset ratio, but has not been determined yet. And other indicators will take into account the results from our climate risk tool. Last but certainly not least, we will also have to make the link between the climate risk tool and the rating of our counterparties. This is a very sensitive subject, because if this will have an impact on our probabilities of default, also on our LGDs, and who says impact on PDs and LGDs says inevitably also impact on the pricing. So it's challenging from an intellectual perspective, because it's difficult to integrate the transition risk into the rating, because it's somehow when we do the counterparty assessment, we already take transition risk into account. So you cannot just add transition risk, or you cannot just add the result of our climate risk tool and say, okay, we make a direct link to the rating. It's not that easy, because we have to avoid double counting, and if we do a direct link, there's a risk of double counting. So we have to avoid this. But we have to do it. The link has to be done, and it has to be, in 1 or 2 years' time, it has to be a full part of our credit rating assessment. The second issue I mentioned is a political issue, of course, because it will have an impact on the PDs and LGDs, so also an impact on the pricing. So you can imagine that our colleagues from the fund office will not be very happy about it, but they also know that it has to be, at one point in time, we will have to be a fait accompli, because we all aware of the impact that climate risk has on our PDs and LGDs. So I hope I was short enough. So there are more things I can discuss about this, but I will let other people talk about it as well.
No, I think that's perfect, and I think you've raised a couple of the challenges, of course, that comes into the use of the results of, are you using it again more from perhaps the review point of the risk department,